Hi, it's Jeff Vogan again from Premier Retirement Planning and Wealth Management. It's Tuesday, so here's the Tip Tuesday of the week. You know, we're just now finishing up the month of September, and it was, as you know, or you may have known because you heard an earlier tip, that it is Life Insurance Awareness Week. You know, I find the biggest barrier to life insurance or the discussion about life insurance is because there's always that connotation of death that goes along with life insurance. But I want to reiterate, life insurance is for the living. Life insurance is about life insurance, whether it's to make up income for the person that you love or the people that you love so they can keep on living and have income replacement when you pass away, should you pass away early or even on time. Those that you leave behind can be made better off. The other thing is I want you to remember that life insurance can also, based on its tax benefits, be a tax shelter, a tax haven. You can even create life insurance savings accounts by not buying a ton of death benefit, but by using the tax benefits of cash value to grow assets in a tax deferred manner, and also take income from that asset in a tax free manner. And upon death, the death benefit, whatever's left in that account, also passes to the heirs tax free. So remember, it can be a living benefit just as a tax shelter or a tax play, especially if you think taxes are going up. And one other thing that people sometimes forget is life insurance can actually be used while you live. You don't have to collect those death benefits when you die. We use a thing called asset-based long-term care benefits. In other words, that asset or that bucket of money that you've set aside that you want to grow tax-free or tax deferred and not worry about the growth and have some really nice growth compared to other safe investments, you can use that cash value, or you can use a distribution of your death benefit early should you become terminally ill or have some sort of a chronic illness where you need home health care, or if you need to go to a long-term care facility. You know, people waste money so often on those pay-as-you-go long-term care policies. If you never end up going into a facility or never needing the care, you just throw away a lot of money, maybe $5,000 or $10,000 a year sometimes, that people are paying just to cover themselves should they go to a long-term care facility. Now, don't get me wrong, I think a long-term care plan is important. I just think there's other ways than long-term care pay-as-you-go insurance to do it, and a life insurance bucket or the LIRP, life insurance retirement plan, can also cover that. So you can look at income replacement for those you leave behind, income streams for while you live in retirement in a tax favored basis, and also long-term care benefits, as well as even a terminal care death benefit where you can access those benefits early. So, you know, don't just look at life insurance as something that only helps others when you die and it doesn't help you at all. You can have a lot of benefits using a creative plan that incorporates what I consider what we call permanent life insurance, not just the term policy that only pays a death benefit, but those that can be used more flexibly for a savings alternative or even an alternative investment that's tax favored. So don't just overlook life insurance because you don't like thinking about dying. Look at life insurance because you want to live a better life. That's my tip of the week. We'll see you next Tuesday.